Welcome to Morphic Labs, and today we are going to be discussing Renku bar aggregation and line break aggregation. But before we get into that, do me a favor, hit the subscribe button if you want to keep up with more content like this. Now, what is a Renku bar formally? And before we do that, if you're interested in increasing your market intelligence, I have a free market microstructure and trading systems course. The link's in the description. Now, let's get into it. Renku bars are formally defined as Renku bars are built from fixed size bricks placed at 45-degree angles, filtering out minor price movements. Here's the formal description. Brick size equals B, fixed price increment. New brick added when price moves greater than or equal than B from the last brick close. Up brick is defined as close equals previous close plus B. Down brick is defined as close equals previous close minus B. Now, when do you use this type of aggregation? Trend following strategies, filtering market noise, identifying support resistance levels, long-term position trading. The advantages of this type of aggregation: excellent noise reduction, clear trend identification, no time component reduces clutter, consistent brick size for pattern analysis. The disadvantages of this type of aggregation: no time information, brick size selection critical, may miss reversal signals, not suitable for intraday timing. Now let's get into the code. Here's my Renku function and my plot. Now I'm going to be using a brick size of about 0.1, and I'm going to be taking about 500 entries from my volatility index 1 minute data. As you can see, we have these bars, and if you go back to the definition, an up break is defined as close equals previous close plus B. A down break is defined as close equals previous close minus B. And a new break is added whenever the price move is greater than or equal than B from last break close. Now, as you can see, the red bars are the down breaks, and the green bars are the up bricks. We have about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. About 11 bricks, and that came from about 500 entries. So we took 500 data points and compressed them to about 10, 11 bars. But let me take the entire data set to show you the full structure. As you can see, look at that. You can see the little bricks, right? These little bricks, the red, green, red, green. All these represent up and down bricks, right? That follow this given definition. Now, that's enough Renku bars. Let's get into line break charts. Now, if you're interested in getting your hands on this advanced market aggregation course, my Discord links is in the description. Join, and I'll walk you through some qualifications to see if you're eligible for this course. Now, line break charts are defined as line break charts draw lines when price exceeds the high or low of the previous end lines, filtering minor price oscillations. The construction rules: line break number n is typically 3. It can be any number, but it's typically 3. New rising line defined as drawn when close is greater than highest high of previous end lines. New falling line is defined as drawn when close is less than lowest low of previous end lines. No new line is defined as if neither condition is met. So if these two conditions, new falling line, new rising line, is not met, then nothing happens. Reversal rule. When reversing, line extends from previous line's close to new close. When do you use this type of aggregation? Trend confirmation in volatile markets. Identifying significant support resistance breaks. To anyone out there who's using support resistance breaks or SR breaks, this aggregation is for you. It's gold standard. Complementing candlestick analysis. And for anyone who's also uh, building their strategies around candlesticks, line break aggregation is for you. Reducing chart clutter in active markets. Long-term position management. Now, what are the advantages and disadvantages of this? The advantages are it's more responsive than Renko charts, preserves some price context, clear trend direction indication, filters minor price fluctuations, simple construction rules. The disadvantages of this type of aggregation: no time or volume information, line break number selection is arbitrary, may miss important intraday moves, limited standard indicator compatibility, less widely supported than other methods. Now, let's get into the code. Here's my line breaks function. Now, I'm going to be using a line break number of 3 at first. I'm going to be taking a fraction of my data, just about 500 entries worth. Now, let's look at it. As you can see, a line break of n equals 3 has this structure. And as you can see, the line is breaking. It's going up, it's going down, and it's creating these new lines, right? And as you look at the definition, new rising line is drawn when close is greater than the highest high of previous n lines. New falling line is drawn when the close is less than the lowest low of previous n lines, right? And a reversal rule: when reversing, line extends from previous line's close to new close. Now, when you look at this, you can see the red and green, but sometimes the movement is so minuscule, it's so granular that it's hard to see the rising lines, right? It's hard to see the falling lines sometimes. And that's essentially one of the advantages, right? Preserve some price context, clear trend direction indication, more responsive than Renku charts. So what you're seeing here with the 500 entries is essentially that the aggregation captures so much of the context of the price that sometimes just looks like it's like black lines, but not really. It's just that those are much smaller price fluctuations. But sometimes you can see the line, the rising lines and falling lines. As you can see, we have a green one over here, we have a red one. But let me aggregate the entire data set with a number of 3. As you can see, much harder to see the line breaks, but you can see that there's dynamics there, there's motion, there's trajectory. Now, what I'm going to do is I'm going to adjust the line break number, right? I'm going to take it from the typical number, which is 3, to higher numbers, right? Numbers greater than 3. So let's take 10. And when you look at it with 10, okay, let me just wait for it to compile. Okay. As you can see, it became more granular, right? You can see the line breaks more, but let me keep increasing so you can really see the visual effect of this. Now the lines are more explicit, right? They might be more of them, but the major ones are more explicit. As you can see, we have a red one over here, we have a green one, green, red, red, green, green, green. But let me take it to the highest number. Not the highest number, but the highest number for now. Let's take it to 100. As you can see, looks like it's just a simple, almost linear geometry, right? You can see the falling line over here. You can see a rising line, another rising line, a rising line, another rising line. I want to try some. I want to see the number in between 50. Okay. Still looks fairly the same. It's just that there's a little bit more rising lines. But that's about it for today's lessons in aggregation. If you're interested in increasing your market intelligence, I have a free market microstructure and trading systems course. The links in the description. And if you want to get your hands on this advanced market aggregation course, my Discord links is in the description. Hit me up. I'll walk you through some qualifications, and I am out of here. Bye.